We spent the Malaysian Multibagger series decoding the business models of Malaysia's greatest wealth machine. But theory alone cannot generate wealth. The gap between learning and earning is actually bridged by two things. The first one is unwavering discipline, and the second is immense patience. So, stock investing is simple, but it's not easy, and the ultimate secret to life changing wealth are just 5 words: buy right and hold them tight. Today, we're going to cover the final chapter of the Malaysian Multibaggers, in which I'll summarize it into 3 main frameworks that every investor needs. And I also reveal the psychology of the endurance protocol, the patience required to separate actually amateur investors to those that make millions. Welcome to the final chapter of the Malaysian Multibaggers. Hello everyone and welcome back to the channel. My name is John, and if you have no clue what I'm talking about, final chapter, follow the entire series of the Malaysian Multibaggers from chapter 1 all the way to chapter 10, and this is chapter 11, which is the conclusion of the Malaysian Multibaggers book. Obviously this video won't do it justice. Please grab a copy for yourself on Shopee, MPH or Popular. We have even distributed it in Singapore. So for those of you who don't know me, new to my channel, my name is John, former engineer turned full-time investor, currently wealth planning director at Phillip Capital, where we help clients with their private mandate equity accounts. And I'm also a licensed financial planner and author of the Malaysian Multibaggers. So this video is really our promise to summarize everything of the book and to show you the mindset, the framework required to really make life-changing returns within the market. And it requires patience though. So the first part is really the foundational mindset, because without it, it's going to be very difficult to build on the scaffold for part 2 and part 3. So buying a stock doesn't mean buying a ticker symbol. It really is becoming a partial owner of a business, which is a living, breathing, dynamic organism. And the focus of any investment should be the business fundamentals, not even the share price movement. The share price movement, if it moves in a negative territory for a good business, that should be a priority, rather than trying to chase after a stock that's already moved. Okay, time is your friend, and the impulse to do something quickly is ironically your enemy. As Benjamin Graham said, in the short run, the market is actually a voting machine. In the long run, it's actually a weighing machine. So ensure that whatever you buy, it is actually weighed very heavily in value, great quality business. Okay, there are 5 rules to live by. The first one, do your homework. Second one, find economic modes. The third one, demand a margin of safety. Fourth is hold for the long haul. And 5, know when to sell when there's a business decay, not based on a price dip or the industry fundamentals has changed. Okay, so once you get this first part framework right, I think 50% of the battle is won. The second framework, or part 2, is really understanding the 4 genes of a multi-bagger. The first one is look for operator owner. Sometimes I call it the alchemist, which is like the guy who mixes formulas. It's like your wizard, right? So if you find an owner operator, first generation family or even second generation family that really like has so much skin in the game, you've likely found a gem. Okay, because management quality really determines is a big determining factor of a success of a business. Because if they're watching all the pennies, they're looking at industry trends, they build a management culture and delegate it well, I think that's where you want them to be your business partners. Remember, partial owner of a business. Okay. So second gene that you should be looking at is what I call the twin engines. You find a small company, but they operate in a very massive, growing, addressable market. And in Malaysia, it is a very small market, 33 million population. You have to find this company based in Malaysia, but somehow their products and services have a global reach. That's what I mean by a large, addressable market. Okay, and then you combine that with the potential for the market to re-rate this company. What do we mean by re-rate? So maybe now they look at it, very small, not growing as fast. I give it a valuation of maybe 8 times PE, trailing earnings, right? But then suddenly they acquire a subsidiary overseas, and that substantially expands the market. And then, wow, this guy is growing by leaps and bounds because it is in a global demand industry that has a lot of tailwind. And then it re-rates and it says, instead of according you at 8 PE, I will accord you maybe even a 15 or 20 times PE, just because they know, wow, the market that you have tapped into now is very, very big. Okay, that's the second gene. The third gene is this thing called the compounding flywheel. So many great investors have said this. If you find a business, a good business, the great business is the one that the more I invest into the business, that means I pour more money into the business, I can expand and expand. The problem is some businesses, it's like, it's great at the beginning, they've captured market share, and then they become the leader. And what happens is, no matter how much money you pour into it, or you put more resources like manpower, because of the size of the addressable market, because there's not much recurring income, you've captured the market and that's it, it becomes stagnating. That's why that compounding flywheel doesn't happen. So you see, right, even though you've got great management, you've got a potential of a PE re-rating, but if you're not in the right industry or in that industry that's already like saturated, that's why that compounding flywheel will not come. That's why we look at this number called return on invested capital. That is the ability for a company or a business to reinvest 100% of its earnings. Some maybe they pay out to shareholders as dividend, but most of it, if you can plow it back into the business and still continue to grow, that is where you get this compounding flywheel effect. And I think that's one of the key parameters that I look for in any company that I invest in, okay? The ROIC number. Number 4 is really this thing called the fortress or a moat. How can this business prevent other businesses from either taking market share, taking their clients, or they are pressured to lower their margins just to maintain market share? Unless a business has this fortress or this moat built around them, which are numerous. There's mainly 4 to 5 of them: low cost advantage, high switching costs, intangible assets, or network effects. These businesses are prone for either market enroachment or non-sticky customers, and the moment the price comes down, everyone rushes to the other guy. So unless and until a business has this moat or this fortress, unlikely it will be able to compound over the long term. So that is part 2, or the foundational structure of part 2, which is the 4 genes of the multi-bagger: owner-operator or alchemist, twin engines of growth, compounding flywheel, and last but not least, the fortress or the moat of the business. Now, part 3 is really not about IQ, but really about EQ. And it's really that psychological war that most investors, including myself who does this full time, we struggle with. Now, the primary reason why a lot of investors fail isn't about back stock picking. They might have picked a good stock, but it's actually their inability to actually just sit still and ride on the winners, or if they realize that they made a mistake, that they invested into a poor quality business, is the inability to cut and move on. Now, I'm not talking about from a trader's perspective cut loss, because from a trader's perspective, cut loss is really share price drop and they cut. What I mean by cut loss is that they have to look at the business fundamentals. Either revenues are declining, losing customer, industry having not a temporary setback but a structural setback that could destroy any businesses within this industry. That is what I mean by the business is failing, and you should have the ability or the courage to be able to cut, not based on share price but on the business fundamentals. So that psychological war, I think really the whole industry actually encourages activity. If you think about it, the broker every day will give you some kind of idea because they want you to trade. The more volume you generate for them, that's how the brokers make money. That's why they give you, they pump you with so much information. People like us who are value investors, the brokers actually don't like us because we don't generate churn for them. And I think that is the key for you to making what a lot of my value investing friends call life-changing money. Because most people get stuck into these 2 traps. Either there's this fear or loss aversion. It means they panic and they sell a great business during a temporary market setback. Or they are too greedy, in a sense that the moment they see market flying, they get into the herd mentality, they buy into the hype, and they buy into this euphoria trends that one day when the valuation when the third tide turn against them, because they bought at such high valuation, there's no margin of safety for them, and they get caught, and then falls back into this loss aversion, and they'll sell at the bottom. Maybe even if it's a good quality business, you see. So I think the psychological war is real, and I think that's something that even I myself have to constantly remind myself: what are the numbers to look at? How do I anchor my decisions? How do I practice that kind of patience in order to enjoy, substantial returns? So anchor number 4, part 4, is really the endurance protocol. I call it the Milotin Masterclass. So in Chris Mayer's book, 100 Baggers, he calls it the coffee can. I don't think people in Malaysia have a lot of coffee can. They are more likely to have a Milo tin or Milo can. And it's just a metaphor for having a metaphor to share with investors that you should treat your investments like 5 to 10 year partnerships. Because as Warren Buffett says, our favorite holding period is forever. Obviously, in today's day and age, sometimes businesses don't last that long, but if you can find one, great, hang on to them forever. And having a Milo tin or a coffee can mindset is really, how do you not interrupt the compounding process unnecessarily? That means if you find a great company, you bought it at a good valuation, great margin of safety, and yet because of volatility of the share price, up 10%, should I sell or not? Should I lock in the gains? Or drop by 20-30%, and they say, oh no, should I cut loss? Right? That conviction, that patience is really what separates the amateur investors to the real investors, because unless you are having that kind of conviction to know what you own and know why you own it, then the fear of buying more as it comes down will become clearer and clearer to you. Like Peter Lynch had this favorite phrase, and it becomes one of my favorite phrases too. He said, during a cheap sale for a like Christmas sale or Black Friday sale, everyone rushes into the sale or into the market. But when the stock market is having a cheap sale, ironically, everyone runs away. And initially you'll be like, everyone is doing it. 90%, 95% of the market is doing it. And it looks like you're crazy going into the market, right? It looks like that, the house is on fire and you're running into it, right? But that is the market for you. And I think that rather than interrupt this process by looking at the stock chart every day, I think a good interval that you should actually review your investment portfolio is really reading the quarterlies, reading the quarterly results briefing or the result announcement by the companies that you own. Because there, within what is being said by management, within what is being guided by management about the industry and all that, it gives you very good clues to how they see the business over the next maybe 2 years, 3 years, or even 5 years. And if a good management, they will actually tell you structural changes within the industry. And that's something that I hope more Malaysian companies do. I really do. Because in the US or in more mature markets, it's already table stakes. That means they share the insights of the industry so that they educate the investors that hold the business together with them. And I love it, right? So it takes serious character to sit with a portfolio to endure market crash and literally do nothing, but that is what separates the boys from the men. Last but not least, if you look at the KLCI benchmark return, it's literally been flat or flattish, yet patient investors, those who upgrade their skill, spend the time, dedicated it to research, dedicated it to understanding and buying and holding these companies, would have found multi-baggers, anywhere between 10, 20, even 130 times like press metal. And I can tell you, these guys, I'm very humbled to know personally some of these guys. They've multi-bagged their returns, so multi-millionaires now. And that is the legacy that they leave for themselves and their family. And it is not measured in very quick quarterly successions, but it's actually measured in years and even decades. But I am more than happy. There was a researcher that we trained on mine. He's now head of research for a financial institution. And he was sharing his story with me, which I think best encapsulates what I'm trying to say. He says he shared this company to his colleague and says, hey, what if you can buy and hold this company for 10 years and you would have made like 50 times the returns? And you know what the colleague replied him? And said, 10 years, so long. But my friend's reply to him was, but 50 times your return. You sure you don't want it? No lah, I want something that gives me back money in 1 year. So you see, I think it's not easy with all this noise. It's not easy to build that kind of conviction over short periods of time. It took me years as well. But that is exactly the master checklist that all great investors I know somehow apply to make sure they have this kind of outsized returns. And if you want to know more, obviously this video will not do justice to the book. Grab a copy of the book. The link is in the description. I apply it to the clients that I help on a global scale. And, some of them have been very lucky. They came in 2024. I think they've compounded their portfolio by like 20%. But I told them, please don't benchmark this, because this 2 years has been very, very lucky. But if you can aim for anywhere between 10 to 15% kind of return compound over long periods of time, I think you'll do pretty well. So looking forward to seeing you in the next video. Let me know your thoughts, your comments, or what you agree, what you disagree, and share with me what are the boundaries or bottlenecks you have as an investor, and hopefully I can make more content about it for you. See you.